Alright, welcome back. Continuing our module 1, the architecture of control section, and this is lesson 3, the liquidity machine and how the financial system actually runs. So, the modern financial system doesn't run on cash as people think. It runs on liquidity. Liquidity means how easily an asset can be turned into money without losing its value. But liquidity as a thing isn't created naturally, it's engineered. And understanding how central banks and largest financial institutions engineer it is the foundation of a true market intelligence. Okay, because this is way deeper than the majority of people actually think. And once again, I just wanted to remind you that we are covering the basics. The module 1 is all about giving you understanding of the structure before diving deep into the actual systems and the actual examples and how to use it and all of that good stuff. Okay, these are the basics. So the engine room, central bank liquidity operations. When you hear sayings from media, from Bloomberg, all of that, CNN, Wall Street, all of that stuff, that the Fed added liquidity, it doesn't mean they printed more money and handed that money out. It usually means they are injecting short-term money into the banking systems using the tools like OMO, open market operations. The Fed buys US Treasury securities from the banks. The banks get the reserves, cash on their balance sheet, and the Fed then holds the treasuries. For example, during the 2020 COVID crash, among all of the markets, the Fed bought over $1 trillion worth of treasuries and mortgage-backed securities in just weeks. So this was the liquidity injection, right? It's not a physical thing. It's just pretty much digitalized version of giving money into the system, into the pile, so to speak. Also, they have a tool that is called repo markets, or known as repurchase agreements, when the Fed or largest financial banks lend the cash overnight to other banks in exchange for collateral, usually different treasuries. It's like a pawn shop for institutions. For example, once again, in September 2019, the repo market froze, so interest rates shoot up to 10%. So the Fed had to step in with the overnight repo operations, lending 75 billion a day to restore liquidity. Once again, as you can see, when you really think about it from behind the scenes, from the different angle, all of this is just a massive invisible flywheel that we call money. Next, reserve requirements and the new money wolf, so to speak. So historically, banks were required to keep a percentage of customer deposits as reserves at the Fed. This was called their reserve requirement. And at the moment, we're speaking about the US system. Okay, it's very similar to, European systems, Asian systems is pretty similar, but not as loose, so to speak, a bit more strict. So for example, if it was a 10% reserve requirement, a bank with 1 billion in deposits needed to hold 100 million in reserves. The rest can be used to lend out. But in March 2020, kinda at the same time of the COVID stuff happened, the Fed abolished reserve requirements. So banks can now technically lend as much as they want, limited only by capital ratios and liquidity regulations. Okay? And it's still active up to today. There are no more reserve requirements. So bank technically does not need to hold anything that you deposit into the bank. They can lend everything. So if you come with $1 million in the bank account, yes, you see that 1 million on your screen, but actually the bank is using the whole million of yours to make money in the system, right? No more reserves. So you may ask, so what's happening? Like, who controls the money creation now? So there is a thing called IOER, which stands for the interest on excess reserves, meaning the interest on the money that banks park at the Fed. So if the Fed is paying a higher interest on excess reserves, the banks prefer to keep their reserves instead of lending them out. So this acts kinda as a reserve that is stored at the Fed. Or if the Fed pays lower interest rate on excess reserves, they are incentivized to lend or invest, pushing money into the markets. So essentially, this is how the Fed indirectly controls liquidity and the whole credit expansion. The banks can hold the money at the Fed if the interest rates on those excess reserves are good enough for them. If the Fed decides to lower those interests, they are able to, they're not able, but they are incentivized to actually use the money elsewhere and deposit, lend, invest, etc. So essentially pulling money out of the Fed back into the system. Once again, massive invisible flywheel. Now, the shadow banking, the invisible network. Beyond traditional banks, there is a massive shadow banking system that is pretty public at the same time. Everyone knows this exists. If you've never heard about it, well, you're welcome. The hedge funds, money market funds, insurance companies, and structured investment vehicles, hopefully I'm pronouncing that word right, it's the most difficult word for me in English, right? That doesn't take deposits but behave like a banks. So the people cannot bring the money in, but they act as a bank, so to speak. So they borrow short term and lend long term. And this is very fragile because when investors pull out or the credit tightens, they face a liquidity crunch. Since they aren't regulated as the banks, they rely heavily on the repo markets and derivatives because all of those operations are based on short-term and long-term loans and borrows. So the overnight lending and borrowing is basically how they keep on running. So for example, during 2008, Lehman Brothers and Bear Stearns, they weren't the typical banks, but they relied on a short-term repo borrowing. When repo lenders stopped trusting them, they went insolvent overnight. So this shadow system is still alive, it's still running, especially in Asia, in offshore companies and countries, even in the biggest places as well. It's just kind of hidden under the layers of ETFs, swaps, and offshore entities. But it's still active, it's still running, and trust me, there are insane amount of manipulation happening with BTC and crypto market in general using the same structures. Gold ETFs and futures market, crypto futures market and ETFs, they're able to manipulate the price using the futures market, the options as well. So this is just a one big game. The spot market is one thing, but the spot market can be influenced using every single other traditional financial tools that were developed to keep the system running. Now, the QA loop. The QA stands for quantitative easing. So when the central banks like the Fed, ECB, blah, 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 Bank of England, Bank of Japan, Bank of China, everyone, when central banks is buying assets, so they actually are deploying the money and the credit into the commercial bank reserves. So that new liquidity doesn't always go into the real economy. It often flows into financial assets, inflating stocks, real estate, and these days crypto. So this is why the market often pumps and goes up before the real economy does. So at the moment, similar situation is happening at the time of this video, when the Fed is actually just starting to cut the rates, starting to inject money back into the system, and it's just the first steps of these things happening, and the market will be reacting positively to that, because even though short-term perspective the market can look bad, bearish, it's going down, whatever might happen, all of the crypto Twitter guys are posting that thank you for your service, I'm out, I'm liquidated, bear market begins. They are not following the major macro events, and they are not following them because they have no idea how it all works. But as long as the depth is expanding, the market is going up. Simple as that. Short-term fluctuations are always happening, but it's part of the cycle. It's part of the game, so to speak. Next, why liquidity is not equal to money supply? Because money supply M2 measures cash, checking accounts, and deposits. Liquidity measures availability of the credit and trust. You can have a very high M2 supply, but low liquidity if no one wants to lend or take risks, right? So for example, once again, 2008, M2 was high, but interbank lending froze. So no one trusted the collateral, so liquidity vanished. And all of that real estate backed, the mortgages backed loans and financial instruments, basically no one trusted that as collateral anymore. And the whole liquidity vanished, and then the market crashed. So the hidden truth is that liquidity is psychological. It's about confidence in counterparties, collateral, and central banks. It's all running pretty much on thin air with just trust and confidence. And that's why money has the biggest saying on the US dollar bill, in God we trust, right? Because it's just a massive, massive scam from the general perspective. Of course, it's very interesting and very nicely engineered when you study it, but at the same time, from a high level perspective, this is just a massive nonsense if you really think about it. Now, the modern implication, the crypto and liquidity waves. The crypto markets react the same way as traditional markets do to global liquidity cycles. If you think that BTC is reaching such a high prices because physical actual people are coming in and buying with their credit card using Coinbase, you are wrong. Just people buying would never inflate the price of the asset by so much. Trust me, there are so massively powerful institutions participating in these markets under different names, so to speak. And the institutions, as people tend to say, oh, institutions are coming, all of that stuff. They are in years and years deep into this game. What they're saying now publicly, that one bank is saying, oh, we actually hold BTC now. Yes, it's the official narrative, but they know this game in and out, right? The Wall Street is in crypto from way back, right? Just random people, retail mind coming in and buying assets, buying different cryptos would not increase the prices of the assets by so much, so quickly, especially when BTC rises, everything rises. This is all a massive network, and mostly the most simple explanation saying why everything moves when Bitcoin moves is because of the algos and market makers. They control the prices, they control how it all works and how it all moves. If BTC is going up and some sort of a bullshit coin is going up as well, like few 100%, it doesn't mean that there are specific tiny group of people noticing that and immediately buying. There are very high frequency algos reacting to every little situation and market making decisions. Simple as that. So when the Fed expands its balance sheet or lowers interest rates, the risk assets like beef, ETH, tech stocks as well, they go up. And when it tightens, right, and the QT begins and the rate hikes, or so to speak, the interest rates are being increased by the Fed, the risk assets then crash, right? Because everyone is selling risk on assets and getting back to risk off environments to safe havens and just keeping the US dollar treasuries and bonds, because the interest rates on those are increased. So it makes sense for biggest institutions to hold that rather than participate actively in a risk on environment. Next, for example, the March 2020, once again, the Fed injects $3 trillion into the system and BTC goes from 4K to 60. Now in 2022, the Fed policy tightens and it reduces $1 trillion from the balance sheets. Then the BTC crashes to 16K. It doesn't mean that Fed is doing anything related to crypto. It just means that liquidity is drying up, it's tightening. And this is why crypto even today is still the best liquidity beta, because that's the purest expression of the global risk appetite. If crypto is pumping, especially everything else besides BTC, it shows that the environment across the markets are entirely risk on, right? If BTC is pumping these days, well, it's a pretty big asset already. Not as big, but it's getting there. So it could act from time to time as a safe haven asset. Still, it's too volatile, but it's getting there. But if anything else pumps massively besides ETH, like the altcoins, it shows that the global risk appetite is very high and the risk on environment is full on, right? And this is what's happening currently at this stage. Slowly, this is happening. More and more alts are starting to see certain rallies, okay? So it's a very beautiful thing to monitor and just follow and see how it all works. So just to summarize and close this lesson, they teach you, by they I mean standard financial educational systems, university, schools, textbooks. They teach that markets move because of supply and demand. In reality, they move because of liquidity and confidence. When liquidity expands, everyone looks very smart because everything is pumping. It's so simple. When liquidity expands and is being injected into the system, everything is going up. So everyone seems very smart because whatever they do, it's profitable. But when the liquidity contracts, and especially if this happens quickly, in some cases overnight, even the best projects collapse. Bankruptcies, in crypto world, the rug pulls, everything is going down and it's the worst possible days in the markets. But the intelligence lies in tracking who controls the flow, what is happening in the markets from the macro events. What is the Fed doing? What is ECB doing and other central banks? Are they buying the assets, injecting liquidity or contracting it? And if it's in between, what kind of tone they are using when they are announcing different speeches, etc., etc. So essentially you have to read in between the lines and try to understand what kind of policy the central bank is chasing for and aiming for, so you know what's coming next, so to speak. If you look at the markets from this perspective, then the short-term fluctuations in prices will not affect you emotionally and psychologically, because at the core of everything, you understand what's happening and what's gonna happen longer term perspective, right? So this is lesson 3. Hopefully it was beneficial, and of course, as always, I will see you on to the next one.